Hi, I'm Richard Vague. Today we want to talk for a moment about derivatives. Complete derivative information is hard to obtain given that some is in private, negotiated transactions that are not captured for the public. But much of it is captured and is available in a report for U.S. derivatives released by the OCC quarterly, and we just received the fourth quarter 2022 report. It's an important report because it represents large bets or hedges that are in essence leveraged positions. Since the economy is impacted significantly and directly by leverage, another word for debt obviously, and since debt is our primary focus at Tychos, it bears close watch in our quarters. The most famous recent issue with derivatives came with credit default swaps, which added enormous damage to the global financial crisis. Here we see that the notional amount of these reached a high of 110% of GDP in 2007, dropped rapidly after the GFC, and are now at a very benign 17% of GDP. That means not many people are betting that credit will go bad. Now, the OCC report is structured to show both the gross and net amount of derivatives. Almost the entire gross amount consists of swaps that are matched off against each other. A hedge that credit performance or interest rates will go in one direction is offset by a hedge in the opposite direction, with the unstated implication, I think, by some that if it's offset, it should not be a problem. That's why the OCC also shows net or unmatched position of all derivatives for banks, which it labels the net current credit exposure in CCE. But looking for changes in both the gross and net positions, in our view, is equally important. After all, the credit default swaps of 2008 were almost entirely offset, but of course not necessarily within the same institution. And those that bet against big credit problems still had to take huge, existential losses. So we look for big changes in the volumes of both gross and net positions. The OCC report shows the 5 major categories of derivatives: interest rate, foreign exchange, equities, commodities, and the one we just looked at, credit derivatives. Gross interest rate derivative volume, which skyrocketed as you can see in the GFC, are now down. Gross commodity derivative volumes have been pretty flat for 15 years now as a percent of GDP. And gross foreign exchange derivative volumes have been pretty flat for about 10 years. That only leaves one of the 5 categories where we would look a little deeper, and that's equity-linked derivatives, where gross volumes rose at the beginning of the pandemic to the level of the GFC in 2019, just before the pandemic. So let me be clear about that. They were already up in 2019, and that implies that in 2019 there was already heightened wariness of the stock market level, which, as distant as 2019 now seems, the stock market was at a record high at that time. Since then, even with all the correction and angst that we've seen, the stock market is at a level well above 2019, and equity-linked derivative volumes have risen too. To us, this is not by itself a sufficient indicator of concern about where the stock market is going to go, but it adds a key element of fragility to the current levels of the stock market, since in any pronounced downward movement in stocks, it would likely bring the unwinding of many of these positions. The net current credit exposure, this net number we talked about a moment ago for banks, is well below the level of 2008. You can find all this in our quarterly sector risk report at tychosgroup.org. That's it for this week. Thanks.